Hello and welcome to the Opes Wealth Management third quarter markets discussion. My name is Aaron Whalen, co-president, and with me today are Mark Duvall, co-president and chief investment officer, and Louis Odette, senior client portfolio manager. Let's start, Louis, by looking back over the last several months. Very few asset classes haven't experienced negative returns. Can you give a little bit of context in terms of what we've seen and why over these last few months?
Yeah, the main trigger has been the Federal Reserve signaling its commitment to fighting inflation, even if that comes at the expense of economic growth. And so that tightening of financial conditions has worked its way into business and consumer confidence as well. And that's starting to show up in things like hiring intentions and spending patterns. And of course, the financial markets have not been isolated from all of this. So investors have started to pull forward their expectations for the economic cycle, shifting from slowdown to potential recession and finally looking through the other side into recovery. And that's impacted stocks and bonds a little bit differently. So bonds initially bore the brunt of the sell-off when interest rates started to increase pretty dramatically, but they've since come down a little bit, which has provided some support for bond prices. Stocks, on the other hand, have experienced an acceleration in the sell-off from the first quarter into the second quarter. And it's important to note that most of that has come through falling valuations rather than reduced earnings expectations, at least officially, although I suspect that implicitly reduced expectations are somewhat embedded in stock prices.
So, Mark, with that framework, how has it impacted client portfolios? What areas have been the most negatively impacted, but what other buffers have been in place that have actually helped, temper what we've seen in the broader global asset classes?
Yeah, I mean, as Louis was saying, the stock market is down around 20% overall. However, we have a value bias because of the growth connection for many of our clients, either through their employment or through their housing. And so while large growth stocks are off 26% year to date, large value stocks are off 12%. So that value bias is helping a little bit. In bonds, we've had a bias towards U.S. bonds rather than international bonds. This year, the U.S. dollar has appreciated quite a bit. So as a result, U.S. bonds are down 10%, international bonds are down 17%. And so that tilt has, again, helped moderate the downturn a little bit. Lastly, in alternatives, where we have the ability for a broad range of choices, we're overweight in alternatives. And that's to offset stock market risk and interest rate risk. Well, both those risks have raised their ugly head this year. And our alternatives allocation is actually up 3%. So that's really helped moderate the downside for client portfolios. And lastly, I guess I'd note that late last year, we sold large growth stocks. Unfortunately, fortunately, really, generating a little bit of tax gains. Nobody likes to pay taxes, but that's what comes from having something that does really well. We trimmed a little bit there, purchased an alternative fund, and in the ensuing 7 months, there's been a 30% return differential between those. So those are all factors that have helped portfolios a little bit.
So now let's look forward. Last quarter, we had the good cop, bad cop construct, and I think you were the bad cop in terms of what could go wrong. So we'll start with you, Mark.
Perfect.
Talk through what are the things that you and Louis talk about that keep you up at night? What are the things that are being broadly covered by the financial press and others maybe not?
Yeah, certainly earnings expectations, which Louis noted, have not yet come down, and yet I think there's going to be a little bit of margin pressure due to increased compensation because of people needing more pay after all the inflation we've had, and then also just due to a little bit of extra inventory from all the supply disruptions that the COVID pandemic has generated. The Fed is clearly raising interest rates, and while the intent is to go ahead and help clamp down on inflation, it may also go ahead and lead into a recession. And that may not be too bad of a recession, but still that would tend to lead to a drop in consumer and business confidence, which would then slow down spending. and we just don't quite know what exactly is going to happen there. And I guess on the lesser known side, around housing prices, they've clearly appreciated a lot through the pandemic period. And with rising interest rates, and then particularly in the Bay Area with stock prices, growth stock prices having come down, that tends to cause the real estate market to soften. And I guess my one bit of advice there would be that if somebody kind of wanted or needed to sell their home, think about doing that sooner rather than later.
Okay, good cop. There's been a lot of bad news, and Mark touched on the most, I think, salient points. One of the big questions is, okay, how much of that news has already been priced in? And therefore, even when it happens, we don't actually see a real erosion in terms of asset prices. What are the things you see out there that you think are underappreciated that could actually lead us out of this and not as a negative tone as what we're hearing at the moment?
Mm-hmm. Yeah, first of all, it's important to remember that a recession is not a foregone conclusion in the near term, right? So the Fed still could engineer a soft landing, although I will acknowledge that the pathway to that outcome has narrowed quite a bit. That being said, if we do get a recession, there are some positives that come along with that, even though nobody would wish for it, right? So there's a healthy dynamic that comes with a normal economic cycle, and there's an aspect of renewal that can come with a recession that helps to purge some of the excesses that can build up late in an economic expansion. And then finally, getting back to financial markets, so valuations for equities and credit have come down quite a bit. Now they're in line or actually slightly below historical averages. So not yet at the point where we find them super attractive and are looking to make big moves and add to positions, but we've been nibbling a bit as distributions have come off of funds at the end of the quarter and the month. And so starting to rebalance and redeploy that back into stocks and bonds.
Got it. Well, thank you. Thank you both for sharing your perspectives. And thank you for all of you for joining us. We'll be meeting with many of you in the coming weeks, and we encourage everyone to reach out anytime you have any questions, either about your portfolio or any aspect of your financial life where we can help. Take care.